My name is Brett Synicky. I'm a consultant here at Sense Financial, and I've had my real estate license for about 10 years, been a real estate investor since the mid 2000s, and I'm joined here by Dmitriy, founder and president of Sense Financial. We're a boutique financial firm that specializes in self-directed retirement accounts with checkbook control. And during this call, Dmitry and I will be taking turns answering the questions today. Just a quick reminder, if you need legal help or any sort of tax advice, please be sure to seek out the proper professional for that. Without
Brett,
further ado, Dmitry, welcome.
Hey, it's great to be here with you. Looking forward to. We got some nice questions pre-submitted during the registration. And just a reminder to all of you folks, as you think of something, think of a question, go ahead and type it in the Q&A, and we'll get to those questions after we cover the pre-submitted questions. Just again, reminder that you're not the only one who benefiting from the answering the question. Everybody else do. So don't shy, ask those questions, and we'll do our very best to answer them.
Yes, indeed. Put those questions in. All right. Well, let's get into the first one from Prasanna Kumar. Do I have to file with IRS? Are there any annual filing requirements that I need to take care of myself for my IRA LLC?
Yeah, so these are actually two questions that came in from Prasanna and Sheldon. They're similar, and both of these are IRA LLC clients, and they're wondering what are the requirements as far as filing with the IRS. And there is not much that you need to worry about. The filing with the IRS is handled by the custodian, which is Solera National Bank. That's who we use as the IRA custodian. They are required for filing annual Form 5498, which is reporting the value of your IRA to the IRS. And they do need your help, your assistance with that. How? And that is reporting the value of the LLC, because with the checkbook IRA, the only asset inside of your IRA is the LLC. So the custodian needs to know what is the value of the LLC, and they will request that valuation from you. It's pretty straightforward. You just simply take all of the assets, all the cash, all the accounts that you have in your LLC, and add all of that up and provide that number to the custodian, and then they will use that to report to the IRS. If you're taking distribution from the IRA, that is also reportable by the custodian under Form 1099-R. So you're actually not specifically required to file any forms, but if you get that Form 1099-R, you will provide that to your CPA and report that on your tax return. So you're responsible for filing tax return, and other forms, those are responsibility of the IRA custodian. Thanks for asking. Good questions. Let's jump into another one. Mukesh is asking how to use solo 401k funds in the stock market. My bank does not offer a brokerage account. Brett, you want to handle this one?
Yeah, thank you. Thanks, Mukesh, for the question. It's a great question, one we get often. Well, with the solo 401k, you have a trust. And first off, on the bank, yeah, that's correct. The bank does not offer a broker. They're not a brokerage. They're a bank, right? So Solera happens to also be the custodian for the IRAs, but they also provide checking accounts for the IRA or the solo 401k. And so that's their role. And if you want to invest in the stock market, and just remember, you can actually invest in any either alternative asset or traditional asset with the 401k other than collectibles. And then with the LLC, the IRA, collectibles and life insurance policies. Well, if you want to open a brokerage account, you can go to any one of the major firms. You can go to Vanguard or T. Rowe Price or Schwab, Fidelity, any of them, and open up a brokerage account in the name of the Solo 401k trust. It's the same way that you would open it up if you were personally going to open a brokerage account. Instead of your personal name, you're going to use the trust, the Solo 401k trust, and its EIN number and all that comes along with it. And then you can invest from that checking account that the trust owns at Solera or whatever bank it's at, and then you can make the investments to the brokerage account as such.
And right. Just to add to that, just a little bit more is, Mukesh, you do want to navigate to the client portal, go to the setup section, and click on the bank brokerage. We actually list all the major brokerage firms that offer brokerage accounts to Solo 401k there, because you do need a specific application. You don't want to just go to their website because you're going to get lost there. Go to the client portal, find the brokerage that you like and wish to work with, and the application will be there. You just complete the application, submit it to them. It's pretty straightforward, but start by going to the client portal.
Yes, thank you for that reminder. Lots of helpful information on the client portal for sure. Okay, Joseph McConnell asks, is the profit sharing contribution based off of the employee yearly gross salary or net salary?
Joseph, good question. The profit sharing contributions are based on your gross salary that you receive as the employee. So whatever salary that you receive, your profit sharing is based on that. Again, that's if you're incorporated or if you have an LLC that is taxed as the S corp. Okay, if you're not incorporated, if you're either partnership or sole proprietorship, it's based on your net self-employment compensation. And Joseph, to you and all who listen, all who are just wondering about the contribution, we do have very, very useful tool on our website, which I encourage you to use, and that is a contribution calculator. So you simply go to the Sense Financial website, go to the Solo 401k section, and then on the sub-menu, you'll find contributions calculator. Go there, just type your salary in there, or first you have to select the S corp, and then type the salary amount, the gross salary amount, and the calculator will run the numbers for you. Do that.
Okay, good. Just Martin has asked a question. I need to know the total cost for transaction. Martin, we're not 100% sure what you're asking here, my friend. If what we'll do is we'll reach out directly to you after this call just to clarify the question. If you're asking about, our services, well, what service we offer, the IRA and the Solo 401k. So we're just a little unclear on this question, but just wanted to acknowledge it here that you asked it. Thank you for the question, and we will reach out directly.
All right, next question comes from Arun, and Arun is asking, income for SD IRA funded rentals is tax deferred. So how does one take deductions for property management, CapEx expenses, and so on? Brett, why don't you take this one?
It's a great question, Arun. And well, first off, the real estate that's owned, any asset that's owned in the self-directed IRA is either going to be tax deferred, right? Or if it's in a Roth, of course, all the gains and everything are not going to be taxed at all when you take the money out upon retirement. But suffice it to say, when you are investing in an IRA or a 401k, there are no taxes. So you're not going to be taking deductions on the property management, CapEx, any expenses that you incur. However, the flip side of this is that it's either growing tax deferred, right? All the appreciation and the income from it, or again, all the appreciation and the income from it is going to be tax free upon retirement if it's in a Roth. One caveat to this is in the self-directed IRA, the real estate that's owned, if it has a non-recourse loan on it or a mortgage, you will be subject to the UDFI, which is unrelated debt finance income, which triggers UBIT or UBIT, which stands for unrelated business income tax, only on the portion, the profit that represents the portion of the real estate that is mortgaged, that is leveraged, right? So if you have 50% down, 50% mortgage, 50% of the profit is going to be subject to that UBIT. Now, on that 50% that's subject to the UBIT, you actually can take the deductions for property management CapEx, can actually depreciate as well. And so you'll want to double check all of that with your CPA before you go forward with the purchase like that. But that's how that works. So hopefully that answers your question, Arun, and really appreciate the question.
Thanks for the detailed answer, Brett. Let's move on.
Chun asks us to talk about the SEP IRA. So Dmitry, go ahead.
The SEP IRA is a short name for self-employed pension. It is designed for also for people who are self-employed, or if you have a business with employees, you can also set one up. But it's similar to a solo 401k, although it's not the same. And for most people who are inquiring about SEP IRA, they will end up benefiting by using a solo 401k because it has a number of advantages that SEP IRA does not offer. And let me see if I can cover a few of them at least for you, Chun. Number one, with IRA, with SEP IRA, you must have a custodian. So there is a middleman custodian that is required. With solo 401k, custodian is not required, so you can set that up as a trust that you control. So that's a major advantage there. You're eliminating the middleman out of the picture. Next, with solo 401k, you actually can fund it quicker, and you potentially can contribute more to a solo 401k comparing with the SEP IRA, because SEP IRA does not have the catch-up contribution. Solo 401k does have a catch-up contribution. The limit for both for this year is $69,000. But with the solo 401k, if you're over 50, you can contribute an additional $7,500 into your account. So that's a plus. In addition to that, with the SEP IRA, the contribution limit is fixed. It's a percentage, 20 to 25%. It does not have the elective deferral component, which is available with the solo 401k. So to give you an example, if you're self-employed with $100,000 of net income, then with SEP IRA, you can contribute $25,000. With solo 401k, you can contribute still 25, which is the profit share. And then on top of that, you can do the elective deferral, which is $23,000. So almost twice as much you can contribute. Again, those are rough numbers, but those are the advantages. And one more that comes to mind is that Brett was just talking about this. If you're using leverage inside of an IRA, that leveraged income from the leveraged portion of the property is subject to UBIT tax, unrelated business income tax. But guess what? If you do that inside of a solo 401k, it's exempt from those taxes. So you can buy real estate inside of a 401k, use leverage, and not be subject to any taxation, unlike with an IRA. And last but not least is the ability to take a loan from the solo 401k. Solo 401k allows you to take a participant loan, which is not possible with an IRA. You cannot take $1 out of an IRA without being taxed. Solo 401k gives you that ability. So Those are some of the differences between SEP IRA and a solo 401k. But June, feel free to reach out to us directly, talk to myself or Brett, and we'll help you make the right decision based on your specific situations. All right. Moving on to a question from Paul. If you don't set up a formal payroll or a W-2 for sole proprietorship, can you still set up a solo 401k? Brett, you take this one?
Yeah, thank you. I mean, the short answer is yes, absolutely. In fact, you can be a sole proprietor, single member LLC, S corp, partnership, any sort of arrangement you have with your business, and you can qualify for a solo 401k. And while we're on the topic of what it takes to qualify for a solo 401k, I'll just mention that you cannot have any W-2 employees other than your spouse. And there are some nuances to that might be best discussed on a one-on-one call, but just suffice it to say, self-employment activity and no W-2 employees other than you and a spouse. But no, you don't have to be on payroll. You can absolutely set up a solo 401k. If you are on payroll, then you do have to make the contributions through the payroll. If you're not, you make the contributions at a later time, or when you take your pay or your draws monthly, however you compensate yourself, you can make those contributions. You can even actually make the contributions in a sole proprietor. You can make them all the way, there's two buckets, right? So at the risk of going down a little bit of a rabbit hole, there's two buckets on the solo 401k contribution. Dmitry was just covering those a little bit when comparing them with the SEP IRA, but you have the employee contribution up to $23,000, and then the employer contribution, or the profit sharing, which bridges the gap from the 23 to the 69,000 max. Well, with the sole proprietorship, you can actually make both of those contributions up until before you file your taxes. If you do it through payroll, your S corp, then you actually have to make those contributions within 7 days of paying yourself. So those are the differences there. But the short answer, Paul, yes, you actually can do it either way. And thank you for the question. Anything to add on that, Dmitry?
Yeah, if you're sole proprietor, there is no requirement for the payroll, so there is no payroll. In most cases, you will not be running a payroll, and you will just be contributing based on your net self-employment compensation. Again, I do want to remind you about the tool that we have, very useful tool, which is a contributions calculator. So go on our website, select the type of business that you are in, select the compensation or the income for the year, and calculator will do the job, will do the rest, and show you what the numbers are for a year.
Excellent, thank you. Okay, Deborah asks, I have a property in a self-directed IRA. Should I sell it before RMD's required minimum distributions begin? And then she said something about transferring. Not sure on that, but that's her question.
Deborah, this is a common question. People do get concerned about the RMD, and the proper time to be concerned about this or be planning this is doing this ahead of time. Obviously, if you're approaching the RMD, sometimes people say, well, I don't have enough money. Maybe property doesn't produce enough income to satisfy the RMD, then you will be forced with some decisions. But first, I want to emphasize that it is very important for all of you who listen here to think about RMD. You may be 30, you may be 40, you may be 50, and you still might have 20 plus years before that RMD, but it will come. So you got to start thinking about this ahead of time. That's number one. Number two, you don't have to sell the property to satisfy the RMD if you have enough income coming in from your investments. So the property can continue to appreciate, can continue to produce income, and you just satisfy the RMD from the income. But if you come to a situation where you are now required to take the distribution and you simply don't have enough cash, then that's a challenge. So there's a few things that you can do. At that point, you can sell the property or maybe exchange it to a more liquid asset, or maybe an asset that will produce more income, which will satisfy the RMD. To give you an example, actually, it's something that I might do. I do have a property that producing about less than 2,000 income inside of my retirement account. But if I were to exchange that, sell that and start doing private lending, I can potentially double that income. So that could be one option to consider, because if you exchange to another income producing asset, you may generate more income. So that's something else to keep in mind. But so you can sell the property altogether, or you can potentially take in-kind distribution. So you could take 20, 30, or 50% of the property out as a distribution. Not the entire property, because that can be a significant tax hit if you do it in 1 year. You may possibly do it in sections. It certainly complicates your situation at this time, because you will have to appraise the property to determine the taxable amount, because you can just use zero from that, or some estimate. You have to have the third-party valuation, since it's a taxable event. And now you have property that is owned by you personally and by your retirement account. So again, that complicates the accounting. It increases the risk of a prohibited transaction, but it's possible, it's doable. Again, just think of that ahead of time. But good question to ask, Deborah. And again, a reminder to all of us that we got to think of this ahead of time, because it's going to come sooner or later. Okay, next question comes from Joe. And Joe is asking, now that my self-directed IRA is set up and owns the LLC, which holds 2 family rental, can I take some of the rent, say 50%, as a monthly distribution? I'm over 59 and a half of age. And if so, should the distribution come from the LLC or from the IRA? Brett, take this one.
Yeah, thanks, Joe, for the question. And yes, you can do that. Dmitry was just alluding to that earlier, where, talking about the RMDs, you're just talking about taking distributions, but you absolutely can do that. You have to go through the custodian in order to do that. The IRA owns the LLC, right? So all the assets are owned by the LLC, which the IRA owns 100% of, but you can't either take the money out yourself by writing a check from your checking account, or doing a wire transfer of some sort. You can't do that, because that would create a prohibited transaction. You must go through the custodian. So the proper tax documentation, in this case, the 1099-R, would be created and tracked properly for your taxes the following, when you file the following year. But yeah, you must go through the custodian, but it is definitely possible to do this. Yep, absolutely. All right. Pamela Newson, asks, where do I get Form 5500 EZ?
Well, Pamela, if you are looking for a Form 5500 EZ, you simply will navigate to the client portal, log into the Solo 401k client portal, and then go to the maintenance tab, and then click on annual filing requirements. And not only we do provide you with the Form 5500 EZ there, we also tell you step-by-step instructions how to complete that form. So each and every field that is required to be completed, we spell that out for you, how to complete that form. So again, navigate to the client portal, go to the maintenance section, and click on the annual filing requirements, find the form and the instructions for completing the form there. And with that, we're going to jump to next question from Matt, who's asking, I have a solo 401k. How much can you put in yearly and write off? How much is business can put in, and how much is personal? Brett?
Okay. Yeah. Thank you. Yeah. And we did cover this on another question, but that's okay. Let's talk about it again because it's important and the numbers can get a little bit convoluted. So with a solo 401k, unlike an IRA, the IRA max is $7,000, right, annually, or $8,000 if you're over 50. You have that $1,000 catch up. With the solo 401k, it's quite literally 10 times the amount. That's why it's such a part of the reason it's such a powerful vehicle to use for investment. You can put in, if you're under 50, up to $23,000 per year. Okay, this is the same as the W-2 401k. And then on the profit sharing side, the business can actually put in either 20 if you're, a single member LLC, not incorporated, or if you're an S corp, you can put in 25%. So 20% or 25% if you're incorporated of the annual, what you pay yourself, right, for the year, right, your gross income for the year. And so you'll be able to again bridge that gap between the 23 and the 69 by getting by doing the 25% of what you paid yourself for the year, or 20% of what you paid yourself for the year. So in Dmitry's example earlier, if you made $100,000, then you could put in 25,000 plus the 23,000. So for a total of 43,000 on that. And I think the only other thing to add on that is if you're over 50 with the solo 401k, instead of only $1,000 catch up, you actually get an additional $7,500 catch up. And that $7,500 comes from the employee side. So your 23 can go up to 30,500. So you actually go from a total allowable contribution of 69,000 up to 76,500. So hopefully that answers the question, Matt. Good question. All right. To Shearing, hopefully I'm saying the name correctly. How can you invest funds that are in a self-directed IRA, and what are the tax advantages of having it? There you go, Dmitry.
How can you invest funds in a self-directed IRA? There is virtually no limit on investing. You can invest in virtually anything. In fact, IRS doesn't give you a list of allowable investments. IRS give you a list of disallowed investments, and those will be collectibles and life insurance contracts. Those are the only two investments that you're not allowed to invest in. In addition to that, you're not allowed to invest in any transaction that involves disqualified person, which is yourself and your immediate family members. Other than that, you can invest in virtually anything. Let me mention some of the most common investments that many of our clients invest. Most of them are related to real estate, and that can be buying a physical rental, or a duplex or a triplex. You can own that kind of property in your retirement account, or you can invest in a commercial real estate, whether it's industrial or multifamily. You can invest a portion in what's called the syndications, where you invest $25,000, $50,000 into a large project that is, say, $50 million, and you own a small percentage, small share of that particular project. You can also invest in tax liens and trust deeds. You can be the bank. You can actually use your IRA as a bank, and you can lend money out as a private lender. So this is a popular way to invest. My personal preferred way to invest. I think it's a great way to grow your retirement money in tax-deferred environment. The benefits or the tax advantages is that, again, if you again start lending money, let's say you have $100,000 savings and you start lending, and you can easily generate 12 to 14% interest by doing private lending. So if you invested $100,000, that's $14,000 in interest income. At the end of the year or in the beginning of the year, you're going to get a 1099 int, which you will have to report on your taxes, and there's zero deductions for that. You can deduct anything off of the interest that you receive. But if you did that inside of your self-directed IRA, all of that income will be sheltered from taxes. So you'll have zero losses due to taxes, and you're going to be able to reinvest that capital. So, and if you did that inside of a Roth, it's going to be the distributions will be tax-free. The earnings growing tax-deferred. Again, you're not paying anything, and then the distributions, qualified distributions, will be tax-free. We do go into more details on our webinar for self-directed IRA, so I encourage you to watch that, or again, contact us and talk to one of our experts about the specific situation in your case. That there might be some specific benefits for you, which we need to get specifics on your situation. But with that, this was the last question that was pre-submitted, and we're going to jump into the questions that were asked here in our Q&A. Again, a reminder to all of you joining us that you can go to Q&A and you can type your question, and everybody else will benefit by the answer to the question. First comes from John, and he says, can you explain circumstances when income from a rental property in a self-directed Roth IRA will be taxed? Brett covered that. Do you want to maybe give a compressed version on that, Brett?
Sure. Yeah, we did cover that when we talked about the UBIT tax on leveraged real estate. So Roth or pre-tax traditional, when you have leveraged real estate in your IRA, the portion of the income related to the percentage of ownership that is from leverage, right? So 50% down, 50% leverage, 50% mortgage, that 50% of the income, the IRS says is because you got a loan, right? Because you have a mortgage. And so 50% of that income is going to be subject to the UBIT tax. And other than that, with a Roth, there wouldn't be any tax situation on real estate.
Yeah, just to summarize, that is only if that rental property is leveraged, John. So if it's not leveraged, if you're on free and clear, there'll be no tax consequences. Next question comes from Rick. Brett, why don't you read that for us?
Other than filing a 5500 EZ for our $250,000 plus solo 401k, what other tax forms are required for 2024?
That's pretty much the only requirement for the plan itself, unless your 401k is invested in some kind of a business that generates unrelated business income, which is subject to unrelated business income tax, so that the UBIT tax applies to leveraged real estate, but it also applies to unrelated business income. So if you're running an active business from the 401k, or you're investing in an active business, then that can be subject to UBIT tax. And one example could be flipping. So if you're flipping properties out of your 401k, depending on the number and the volume and the repetition of that, it could be considered a business, and income will be subject to UBIT tax. So talk to your CPA, but other than 5500 EZ for the plan itself, that's it. Now, obviously, you have to report the contributions, if any, but those will be reported on your personal tax return or on your corporate tax return if you're making profit sharing contributions. So talk to your CPA about that, but contributions are reportable on tax return. And then we got John asking another question. Is it necessary to hire a property manager for rental property in a Roth IRA? Let me answer that. No, it's not required to have a property manager. You don't have to have a property management company. There is no such requirement, but you have to remember that you are a disqualified person to your IRA, to your Roth IRA. And as such, you're prohibited from providing any services to the plan, to the retirement plan, or benefiting from it in any way. So if you're doing the management, you can't receive any compensation for that, and you will be limited in the scope of what you can do. You can certainly deposit the rent payments. You can pay the bills. You can take the call from the tenant. And if there is a repair that needs to be handled, you cannot do it yourself. You have to outsource that to unrelated third party, but you have the freedom and power to choose who's going to do that kind of repair. It has to be hands off. And one illustration that we like to use is the difference between a blue collar worker and a white collar worker. So as a blue collar worker is someone who's actually working there with their hands on the factory floor, can do those types of work activities. But the white collar type of work, when you are at the office in a white shirt and tie, and you're on the phone, you're doing the paperwork, you're on your computer, you can do those kind of administrative functions for your Roth IRA. Let's read next question, also from John under what circumstances will income from a rental property in a Roth IRA incur unrelated business income tax? Okay, so Brett just covered that. And John, we trust that was to your satisfaction. If not, feel free to reach out. Next question comes from Yin, who's asking, I have a solo 401k. So far, I've only been using it to invest in the stock market. I want to use some of the funds to invest in real estate as a limited partner with regular distributions for a few years until the property is sold. What needs to be done to ensure this doesn't trigger a taxable event? Brett, you want to handle this one?
Sure, yeah. You might have to add some color after I'm done, but I'll give it a shot. So it sounds like it might be a potential syndication of some sort, maybe. However, I think it depends on how the limited partner that you're partnering up with actually is going to fill out the K-1 form that you're likely to get. And so depending on which box they check, you could be subject to UBIT on this. And so this is something that we definitely would advise before you do to make sure that you check with your CPA or other tax professional to ensure that if it does trigger a taxable event, you know what kind of taxable event it's going to trigger. And if this involves, it does involve real estate, your question says that. So, bear in mind, UBIT sounds, I think it sounds a little bit scarier than it actually is if you break down the numbers, because you are able to write off at least the portion that you own. You're able to write off some of that on the depreciation and expenses and such. It actually lowers the taxable amount down quite a bit if you break down the number. But again, you should double check with your CPA on this.
Brett, maybe you missed the solo 401k part. So it's not an IRA, it's a solo 401k. So if they invest in like a syndicated deal, which is, again, real estate, using a solo 401k, there won't be any tax consequences. It's a passive investment. You're investing with your solo 401k passively, and it is a 401k which is, even if the deal is leveraged, which most syndicated deals are leveraged, if you're using your solo 401k to invest, there will be no tax consequences. But what Brett mentioned, that applies to an IRA. So if you did that with a checkbook IRA, then there could be possible tax consequences because of the debt involved. But again, run the numbers with your CPA. Usually it's insignificant, and still ROI is good enough that it's worth making that investment. But the bottom line is that you do want to identify the investment and then make sure that you're doing all the paperwork is in the name of your 401k trust. So the name of the 401k goes as the investor. You use the tax ID number that is attached to the 401k in relationship with this, all the paperwork that you fill out. And when you complete the W-9, reference the article we have in the knowledge base that we actually tell you exactly how to complete that. So that could be a tricky part because you don't want to make a mistake there completing that W-9, because based on how you complete that W-9, the K-1 will be generated to you next year. So you want to make sure you do it correctly.
All right. Okay. Go ahead.
Okay.
All right,
why don't you read the next question for us, Brett?
Yep. So Diago, hopefully I'm saying your name correctly. My financial advisor stopped recommending solo 401k after one of his clients passed away, and it was difficult and time consuming for heirs to get control of assets in the solo 401k. What do you think about this?
It's certainly, I've seen that happen with some of our clients, but it can happen with any retirement account. Obviously, it is more complicated here with the solo 401k plan that is self-directed because you have alternative investments. And again, Diego, this is a reminder to you and to all of us that we need to have proper records. We need to have, if you're investing in alternative assets, have a spreadsheet of your assets and make sure that your spouse and your beneficiaries and people that you trust have maybe 2 or 3 people that have that spreadsheet, or a copy of that spreadsheet. Keep that updated maybe once a year, so that if something happens to you, then your spouse and your beneficiaries have an easy way to identify what the assets are. Other than that, it's pretty straightforward. If a spouse inherits 401k from a spouse, it can be moved to their own IRA. If it's a non-spouse, then those assets will have to be moved to inherited IRA. We are actually dealing with a couple of clients who are in that stage right now, moving the assets. It's certainly more difficult, and perhaps again, as you get older, maybe you can simplify your investments. And but again, it's something for you to plan. It needs to be planned, and make sure that your loved ones are aware of what's in your solo 401k plan. Okay. Another question from Diego, who's asking, what is the main difference between self-directed IRA and solo 401k? Brett, take away this one.
Sure. Yeah, we've kind of peppered this answer throughout the webinar, but just to put it in one shot here, the main difference, of course, is the annual contribution limits, 7,000 versus 69,000 annually. Another one would be no UBIT on leveraged real estate, as we've discussed. And then something we haven't talked a lot about, but Dmitry did mention it when comparing the solo 401k to the SEP IRA, is the participant loan option. So with the solo 401k, you can actually borrow up to 50% or $50,000 of the total 401k plan assets, whichever is less, and use it for virtually any purpose. People have used it to pay off high interest credit card debt, or add to their business, their sponsoring business in some cases of the solo 401k plan, so that they can infuse that business with cash to use it for marketing or hiring somebody or whatever. And the benefit is you can use it for any purpose. It's your money once you borrow it. And the benefit is, instead of borrowing it from somebody else, you're paying back your own retirement account. And the interest rate would be prime plus 1% over a 5-year amortization period, or 15 years if you're using it to put into a down payment on a personal residence that you're going to live in. So those would probably be the top 3 benefits, differences there. And a couple others, actually one is it's a lot easier to set up. It's quicker, it costs less. And the maintenance is, as we've discussed, is the 5,500 EZ that has to be filed annually once you get $250,000 or more of total plan assets. And then we walk you through, as Dmitry mentioned, on our client portal, of exactly how to fill that out. And there's no requirement for a custodian, so we can create the trust and get rid of the custodian so that you have your checkbook control. Whereas with the IRA, you still have to have a custodian even with checkbook control. So those would be the main differences, Diago. Hope that answers your question.
And last item to mention, while anybody can set up a self-directed IRA, not everybody can set up a solo 401k. Solo 401k is specifically designed for those people who are self-employed or own a business and without employees. So you have to be eligible to set up a solo 401k, but benefit-wise, it surpasses an IRA. So keep that in mind.
There you go. All right. Cody asks, if I use a solo 401k to buy a property, can I set up a separate bank account at Solera to account for that investment?
Yeah, you certainly can, Cody. You can set up a bank account specifically for that property, although you don't have to. Now, if you're using money, let's say from the pre-tax 401k and then portion from a Roth, you do want to do that because you're now combining the funds, or maybe with your spouse's account, because you can have multiple accounts in your solo 401k, and you need to account for each type of money separately. So we do recommend setting up like a operating account for the investment if you put in the funds together. But if you, let's say, using your Roth 401k account to buy the property, you don't need to specifically set up another account just for that property. But if it helps you with your accounting, then you certainly can. There's nothing prevents you from doing that. All right, next question comes from Joseph, who says, when I provide Solera the value of the real estate, do I use the purchase price plus improvements, or the new current value? And I think Joseph is referring to the annual valuation of the LLC, if you have a checkbook IRA, that you're required to provide to the custodian. So if you do that, or whenever you do that each December, Joseph, you have to provide the value of the LLC, not just the real estate. But obviously, if you have real estate, then you have to provide the value of the real estate. And it is not the purchase price, it's not the improvements, it's the value of the property as of that date. So let's say you're providing that valuation this December 2024, you can, and if you purchased the property a year ago, you can't use the purchase price. You have to provide the value as of December of 2024. And because this is just for reporting purposes, you don't need an appraisal, you could use value of zero to determine the value of the property. Sometimes, depending on the county, assessed value of the property might be close enough to the market value. That will work also, but it's the value of the property on the time that you're assessing that value, not the purchase price. All right, next question from Mukesh. Between solo 401k and self-directed Roth IRA, which one will be a good recommended option to buying and maintaining rental properties? Brett?
Well, I mean, yeah, you could do either one. The difference is, I think, with the solo 401k is are you self-employed with no full-time employees other than you and your spouse? So first off, you have to qualify for the solo 401k. Certainly the solo 401k has a Roth component built into it. So you can do either pre-tax contributions or Roth contributions. Now the Roth contributions need to be made on the employee deferral side, not on the profit sharing side. Nevertheless, with the Roth IRA, and of course the differences between those is the contribution limits up to $23,000 in the 401k or $30,500 if you're over 50 versus 7,000 or 8,000 with the IRA. Obviously, the contribution limits are higher with the 401k. But to answer your question directly, I think it depends on which one you have set up, because both of them are a great option. Of course, the difference being with the IRA, if you do have leverage on that real estate, you are going to be subject to that UBIT tax that we've discussed a few times. So that it just depends on which one you have set up, but either one is a good option. So hopefully that answers your question, Mukesh.
All right, we are a little bit running out of time here, so we gotta speed up. Next question, Brett, why don't you read that for us?
What is the risk involved? This is from Mukesh also. What is the risk involved in buying and maintaining rental properties with the funds in the solo 401k? Because there will be a lot of transactions like rent, credit expenses, utility payment, insurance payment. I'm a bit worried about prohibited transactions.
It's pretty straightforward, Mukesh. If you have a solo 401k that owns a rental property, all of the expenses that are directly related to that property must be paid from the 401k account. The key, again, is directly related to the property. So property taxes, insurance for the property, repairs, property management fees, utility usually paid by the tenant, so you don't pay those. But if property is vacant and you have to pay utilities, then yeah, you got to set up the account and in the name of the 401k and pay from the 401k. And all of the income must go back to the 401k account. So it's pretty straightforward. And again, usually if you have a property manager, which is recommended, not required, but recommended, your property manager will handle most of that, and you just get monthly deposits to your bank account from the property manager. But that's pretty straightforward. Again, if you have a specific situation, feel free to reach out to us.
Okay.
Next question from Jan to Brett. I think she's speaking back on the question that was asked or Brett addressed earlier. What is the rule around making a contribution within 7 days of paying yourself? This is the first time I'm hearing about it.
Well, if you, Ying, are on payroll, if you have yourself set up on payroll for the business that's sponsoring the solo 401k, you need to make those contributions through the payroll. This is if you're incorporated. If you're a sole proprietor, single member LLC, this requirement doesn't apply.
Yeah, and just to add to that, Ying, if you run in a payroll, you pay yourself X amount of dollars, and you're designating that 5,000 will go to the 401k. After the payroll date, you've got 7 days to deposit that. You can run a payroll and then, wait 6 months to deposit that contribution. You got that window of 7 days after you run the payroll and designate those contributions, because you have that fiduciary responsibility. You handling the money, you got to move them into the 401k. All right, next question from Ed. Would you please go over what is Sense Financial Ultimate deliverable and value add propositions? Okay, I'm not sure if I understand this question, and since we're out of time, we'll skip that, and Ed will get to you directly so we can clarify the question. Next question from Paul. Thanks for the great information you're providing. I had another question. I understand that SD IRA can be used to buy life insurance. However, can a solo 401k be used to purchase life insurance policy? Are there any restrictions on whom the policies can be purchased? Yeah, so the solo 401k doesn't have that restriction, but it can be only made as an investment. So it has to be investment, and so it has to be certain type of policy. We do have an article on that, Paul, so I'm going to go ahead and send that over to you to clarify it for you. All right, next question. Does the interest paid to solo 401k personal loan count towards contribution limit? Brett, can you do that?
Joseph, yeah, thanks for the question, Joseph. No, it does not. That is separate from the contributions.
All right. Next, Joseph also asking, can my trust be the beneficiary of my solo 401k upon my death?
Yeah, Joseph, it can. Thank you for the question. What a lot of people do is they put their spouse as the beneficiary, and then their trust would be a secondary beneficiary. But the short answer to your question is yes. And this is probably something you should run by your CPA or other potentially asset protection attorney that you're working with. But that's the answer.
Yeah, you can put anybody as a beneficiary. Feel free to put myself.
Me as the secondary.
All right. Next question from Ying. Thanks, Dmitry. Yes, I want to use my solo 401k to invest in syndication as a limited partner. I want to make sure I'm filling out the paperwork correctly to ensure everything gets done without any unintended tax triggers. I will reach out to your office later to ensure I'm filling out. Okay, so that was more of a comment, not a question. Glad we answered your question and we understood that. Next, Diego, tax is deferred, but it needs to be paid at some point, right? So the choice is between paying tax upfront or later.
Yeah, Diego, thank you for the question. I think the question you have to ask yourself and potentially your CPA to find out what kind of tax consequences you're looking at is, do you want to pay taxes on the seed or the harvest? And obviously, as the fiduciary, your job is to grow your retirement account as effectively as possible. And so when you do when you are going to invest, you are going to either invest with pre-tax money or you're going to invest in an after-tax Roth. So of course, after-tax Roth means you're investing with taxed dollars, right? Well, that's going to grow. And so taxes are going to be whatever they are when you start to take distributions or RMDs down the road. And so you want that to be as minimal as possible. And the idea is that it's going to be much bigger than what you actually start with. So I think anytime anybody can invest with a Roth, that should be their first choice.
Okay. Why don't you read the next question for us, Brad?
Solera would not open up a checking account for the New Jersey LLC that owns the property, but my local bank that wouldn't open a checking account for the self-directed IRA was willing, self-directed 401k, excuse me, was willing to open an account for the LLC. So this is Joseph's comment. I'm not sure if there's a question, but maybe Dmitry, you'd like to comment on what he said.
Yeah, I'm not sure if I have any comment on the comment, but Joseph, feel free to reach out. We'll talk about your specifics. Sometimes it's difficult to talk about the specifics of the client particular situation, so feel free to reach out. And Brett, I believe you missed a question prior to that.
I did, you're right. My bad. Tom asks, what are the pros and cons of borrowing from a self-directed IRA and placing it in a Roth IRA?
Well, Tom,
you go ahead, Dmitry.
It's not possible to borrow from an IRA, so you can't borrow money from an IRA. So it's not going to work. All right, next question from Ying again. Does Roth Solo 401k contribution allow me to follow the same income limits? So if the business makes a lot of money, Roth Solo 401k contribution will not be possible then. Brad, you want to address that?
Does the Roth Solo 401k also follow the same income limit? So it's business mix. Oh no, there are no income limitations on the Roth 401k. You can make as much money as you want in your business and still contribute on the employee deferral side of the Roth 401k.
Yeah, that's the beauty of the Solo 401k.
Indeed. Okay, for a new self-directed checkbook IRA setup using Sense Financial, can I use Schwab as a custodian, or I have to go with Solera Bank only? This is from Mukesh. Can I answer the question?
Sure.
So Mukesh, good question. Well, the answer is you could not, because Solera offers investment into alternative assets, whereas even if Charles Schwab offers what they call an IRA, first of all, you're not going to get checkbook IRA, so you're going to always have to go through the custodian for everything. And at that point, it's just going to be a traditional IRA. So you're going to be restricted to what Charles Schwab as the custodian offers, which is going to be stocks, bonds, mutual funds, and ETFs. So if that's what you want to invest in, just go straight to Schwab and open up an IRA like anybody else would. But if you want a checkbook IRA to invest in alternative assets, you must use a custodian that will allow alternative asset investing.
All right, next question from Mukesh. Thanks a lot for sessions and clarification, very helpful. I'll continue doing business with you guys and keep referring you guys to my network. Okay, so that wasn't a question, but appreciate the comment, Mukesh. Happy to serve you. Next, Doris asking, do self-directed IRA and Solo 401k have to register in the Corporate Transparency Act? So that's a recent law, and no, that's a requirement for LLCs and corporations only. So if you have a checkbook IRA where there is an IRA owned LLC, the LLC has to register, but IRA itself and the 401k itself are not. Okay, and then Joseph saying I threw that in because someone asked if Solera will open an account for their real estate LLC. They told me only if the LLC is in Colorado. Okay, so I'm a little bit unclear on that, but that will be the last question, and we are out of time. We are past the hour. Thank you guys for joining us. I enjoyed reading the questions and answering them. I'm sure Brett as well.
Thank you.
You guys have a great rest of the day, and we'll see you next time.